What happens if I reaffirm my mortgage during bankruptcy? Have you ever wondered what it means to reaffirm your mortgage during bankruptcy? It's a question that many people ask when facing financial challenges. Let's break it down in simple terms. When you reaffirm your mortgage, you are signing a legal agreement with your lender. This agreement allows you to continue making mortgage payments as if the bankruptcy never happened. It's important to know that by doing this, you remain personally responsible for the debt, even if most other debts are wiped out in bankruptcy. There are different types of bankruptcy. In Chapter 7 bankruptcy, most debts are eliminated. However, secured debts like mortgages can be reaffirmed. On the other hand, Chapter 13 bankruptcy involves a repayment plan. In this case, you usually keep paying your mortgage unless you decide to give up the property. Now let's talk about what secured and unsecured debts mean. A mortgage is a secured debt because it is backed by your home. If you stop making payments, the lender can take your house through foreclosure. Unsecured debts like credit cards do not have this kind of collateral. So, how does the reaffirmation process work? First, you need to sign a reaffirmation agreement with your lender. This document must be filed with the bankruptcy court. The court will review the agreement to make sure it is in your best interest. If the court approves it, you are legally bound to the agreement. This means you must keep making your mortgage payments as outlined. One key point to consider is personal liability. By reaffirming your mortgage, you are still responsible for the debt. If you default later, the lender can sue you for any remaining balance after foreclosure. It's essential to weigh your options carefully. You could choose not to reaffirm and either surrender the property or try to redeem it by paying a lump sum. Now, let's discuss the impact on your credit. Reaffirming your mortgage can help maintain your credit score over time. This is because consistent payments show responsibility. However, keep in mind that filing for bankruptcy will initially lower your credit score. The positive effects of reaffirmation on your credit can be significant if you continue to make payments as agreed. Reaffirming your mortgage can be a smart move if you want to keep your home and can afford the payments. It's crucial to assess your financial situation before making this decision. Consulting with a legal expert can help you understand the implications of reaffirmation and ensure that the agreement is fair. In the context of bankruptcy and mortgage applications, reaffirming your mortgage allows you to maintain ownership of your home while still being responsible for the debt. This can be beneficial if you want to keep your property and are financially capable of making those payments. Just remember to weigh the pros and cons based on your unique financial situation.